welcome back to NDTV Profit. You're watching KYC or Know Your Company. My name is Puneet Zaveri, and over the next half an hour or so, we'll try and put focus on that one company that is on our radar today. We've seen broader market correction, but Nifty Realty as a space has been hit the hardest, and hence a company from that index, a company in the real estate space, and we're talking about Marathon Nextgen, a Mumbai-focused real estate developer, largely residential as well as commercial projects is what they operate, with a portfolio spanning across the affordable premium luxury as well as the commercial and the retail space. So you get the whole gambit with this particular company. Did turn net debt free as of Q3 of FY26 with a very interesting QIP that the company did of almost 900 crores raised back in June and July. That has had an impact on the shareholding of the company, and we'll get to that, one of the parameters, in just a bit. But a 5-year profit CAGR of almost 43% has been quite strong at this point of time, given the post-COVID rush as well as sustenance of the same as well. Profit have also expanded consistently post FY22, as I mentioned, and one of the biggest aspects was the merger of Marathon Nextgen Township, which is effective of FY25, and hence there's a lot more to talk to the company about this. When you look at the primary products portfolio of Marathon Nextgen, though, the residential as well as the development as well as the affordable and premium housing is what the company operates in. So that has been a space that they want to earn, and it's very evenly balanced. In terms of some of the key projects, though, Monte South in Baikala, the next zone in Panvel, which is a big, huge township that the company is developing, as well as new homes in Bhandop, are some of the exposure that the company has in the MMR region, and that's Mumbai Metropolitan Residential Region for those who are new to this space. So this has been where you've had a decent uptick essentially in land costs as well as the price per square feet, and all these companies benefit from that. Amongst the other key project has been the Nirvana collection that the company launched back in November of 2025 at Panvel, almost a 600 crore gross developmental value, which essentially means the development potential of that particular land parcel. Amongst the segments where I've spoken about, revenue has been, 60% or majority of that coming in from the residential space. You've seen roughly realization of almost 18,000 rupees per square feet. But look at the revenue mix for commercial as well, because you see a higher realization there. So 40% coming in from this aspect. And while it's not as stable as a residential project might be, given that you could go out and sell out a number of projects within a particular span of time, you might have to deal with renters amongst others. The realization makes up for it at this point of time. Now, very importantly is, and as I spoke about, the diversification, right? Commercial segment drives the higher realization as well as margin stability. But when you look at the diversified product mix, because of the townships in Panvel as well as projects in Bhandop, the affordable residential portion has now come to almost 30%. Now that's the blue bar down at the bottom. You are seeing roughly 24% come from the mid-size residential, and the commercial, which we spoke about a higher realization, is almost 26% of the company's revenue, with almost 20% coming in from the luxury space, where the company actually started out in Lower Parel, where they have a major commercial mix. So hence the realization and the meat of the margins comes from those commercial businesses. But in terms of the affordable side and the residential township side that the company has done, it's coming in from this residential side, which is almost 60% of the revenue. Move on and look at the key rating parameters now, because we have been talking about how important it is for a company like Marathon to give us some perspective on the income statement, balance sheet, and cash flow as well. Now, you would be seeing that volatility across years for some of the key real estate makers, and hence what I would urge you to look at is the historical time frame that we're presenting, because those 3 years give you that perspective much better than that individual time frame as well. We'll also look at return ratios at this point of time. Along with that, look at the shareholding, which I've mentioned would change a little bit post the QIP. Street cred has been something that you and me are well versed with in terms of valuations as well as the stock price that it has been impacted. Put some focus there as well as very operational metrics over the last 3 years, what have been the company's period at this point of time. the next part has been the first parameter that we look at, and that's income statement. Now, when you look at FY24 to 25, you see that variance I was talking about, but the 3-year CAGR, both for revenue, its EBITDA as well as profitability has been quite decent, especially on the bottom line. So a 70% CAGR from the FY23 levels. We have hence given this company a thumbs up at this point of time. But the quarter 3 also a very, very interesting time, because you saw that impact coming in for quarter 3. Labor code was a big impact. So you've seen profits dip by almost 33%, and so has the EBITDA, with a marginal growth in terms of revenue. So in quarter 3, the company's booking number was also in the lower side, and hence the margins hit the lowest, which it has been, but has been consistent at the 30% range, and hence a lot more to go for the company at this point of time. In terms of the balance sheet, that has been the other aspect. Share capital is largely reduced, but the increase of reserves from 762 crores all the way up to 1100 crores gives the confidence in terms of what the company's strategy has been in the long term, while the total equity has also seen a substantial increase because of the reserves at this point of time. We continue to monitor the company's borrowing, and they have gotten net debt free as of this. So you are seeing a 560 crore number as of FY25. That's literally become zero for the company because of the QIP, and this was something that they had spoken about over the last couple of quarters in conference calls. The net debt free was one of their agendas and now has been achieved. Cash in bank has also remained quite stable at about 100 crores, and hence a thumbs up that we have given to Marathon Nextgen also on this particular parameter. So that's 2 in 2. Does the cash flow give us that perspective also is the other key aspect I want to focus on, because cash flow from operations as well as is one of the major drivers from profitability as well, and here is where the variance of the company is. So in FY25, because there was the negative CFO, and it's largely also basis of what the company has been investing, you see that operations to PAT number largely been missing from here. But the company has been, in terms of the net cash flow, got back to the positive net cash flow trajectory. But because there has been that variance, a lot of new projects coming in on stream in FY27 amongst others, hence we've given this a neutral rating for now. A lot more to watch out for essentially at this point of time for Marathon Nextgen within the cash flow side of things, and hence a neutral rating for now. Look at the return ratios though, and that gives you another perspective. It's better to look at the whole 3-year CAGR. 13 to 14% is a decent number for a real estate company as well as amongst other sectors that we look at. Of course, a much better improvement from FY21 levels, but within this time frame, and hence given this neutral rating for now yet again, has been the other factor in terms of sustenance of that and improvement from this. ROE is the other factor, very decent of between 16 to 18%, and hence while the ROC might be a little lower at this point of time, you would expect a lot of investment made in townships amongst others, and hence a neutral rating on the return parameters as well. Shareholding is the other key factor. We've consistently highlighted that because of the QIP, you will see a big difference between the promoter, the shareholding between March as well as December. But what's interesting is the increase in foreign investments as well as domestic investors substantially between those 3 quarters, and a lot of that QIP effect you see across the parameter now. A 24% shareholding from the public is also giving you that confidence that retail investors have bought into the story. So for that, as well as the promoter maintaining about a 50% share, we have given this company a thumbs up. Future debt raises will be something to watch out for, because one more raise of equity will dilute this number further, as well as for the existing shareholders as well. So continue to monitor shareholding, but for now, given the historical evidence that we have, we've given this a thumbs up. Look at the street cred though, and here is where we've been talking about the disappointment that across the space, because of the Israel-Iran war, has started to hamper the company's share price performance. Amongst other key factors, along with Nifty Realty, has been the other key impending impact of down almost 31%. 1-year return is down almost 21%, but the 5-year return for the company, though up 5x, still the near-term underperformance has been quite constrained. And now with FY26 almost over, with the company yet to report quarter 4, you're seeing debt being pared down, and hence this could be a very interesting play going into FY27, and we'll quiz the management on that too. Valuations is the other factor. As for real estate, we try to look at the EV by EBITDA metric for these companies. You've seen roughly a 17 to 18% metric for a lot of these companies trading in that valuation. So Marathon, of course, Sri Lotus, a recent listing, while the Nifty Realty as a whole also trades at roughly around 20 times. So you're seeing Suntech also trading at almost 22 times EV by EBITDA. This one, of course, is something to watch out for. So it's not extremely expensive, and giving the correction gets you into a lucrative factor. Finally, in terms of operational metrics, that is the other factor. We've consistently highlighted that the area sold by the company has consistently increased. So has the booking value. Will remain stable in FY25, but is yet to jump in back again in FY26. Pardon me. And collection been quite decent as well. Given this a neutral rating for now, to get some more perspective from the management in terms of the booking values, that will be something to watch out for in FY26, because we have seen the 3-quarter numbers has been quite decent as well. But go back to look at some of the key parameters as well, as which we've spoken about, highlighting that the financial performance gives some perspective for income statement, which is a thumbs up for now. We've also given a thumbs up on the balance sheet, while cash flow and return ratios gives you a neutral rating for now. In terms of what we've seen, the company's shareholding post the QIP, there has been a change in structure, a thumbs up here as well. Street credit, like the other real estate companies, has been down, so we'll continue to monitor that. But valuations as well as operation metrics give you some more confidence at this point of time. So overall, when you pull up the ratings, the company is trading at 5 out of 8 of the ratings for KYC right here on NDTV Profit. But important to get some perspective now from the management. Mayur Shah, the vice chairman of Marathon Nextgen Realty Limited, is now joining us to give us exactly that. Mr. Shah, a very good morning to you, sir. Thanks so much for joining in right here at NDTV Profit. My name is Puneet. Just the first question, right? Because we've seen Marathon transition continue to maintain in terms of the luxury space and now going into affordable housing as well. Give us some perspective of the company's strategy to have and go into townships at this point of time, and in terms of how that would change your financials, if any perspective, to start us off.
Good morning. Marathon has always been looking at a very balanced portfolio in every cycle of the project cycle, particularly luxury, commercial, outskirt township, and affordable segment within Mumbai. So we've been balancing that portfolio for quite some time, and going further also we would like to balance it, because we are seeing a very strong push of infrastructure by the government in almost all the across Mumbai MMR, and we feel that luxury as well as affordable and outskirts, including commercial within city, is going to do very well in the next 3 to 5 years.
So how would you see the change? So because, we did pull out, Mr. Shah, the change between the metrics. So affordable continues to be at almost 30% of your portfolio. Residential is almost, the mid-size residential is almost 24%. Commercial is almost 26%. So how would that mix change with the townships coming in? Do you feel that the overall residential metrics close to 60% will increase slightly over the next few years?
Yes, but see, it depends on the cycle of the project also. Many times you have commercial projects start reflecting at the end of the project, because it's all sold in a ready inventory kind of a thing. So we'll be starting building a new commercial inventory in the next year and next 2 to 3 years. So more or less this would balance will be similar to what you are seeing right now on the screen, because of the affordable housing in the outskirts, where our portfolio Panvel is doing very well, and we really want to really increase that portfolio to some extent. And also the Bhandu, where we have SRA portfolio, that also contributes towards affordable. These two, affordable housing has a very ROI is very high, and the sales velocity is much better than the luxury, which we have seen over the period of the time. So we keep tweaking this balance between the portfolios which we have in our own micro markets.
So 2 key questions now, Mr. Shah, from what you said, that you will be looking to rebuild your commercial portfolio yet again in the next 2 to 3 years, because a lot of your legacy commercial portfolio in Lower Parel has been doing very well, that your average realization also quite high. Where can we expect in terms of this commercial properties to come in? Will that be largely in the outskirts, as you mentioned, or will that be in these spaces where your realization has been quite high because it is a very competitive market there? So what would be the strategy be there for the commercial portfolio? Which kind of areas would you want to be targeting at this point of time?
So we will be targeting commercial portfolio. A major portfolio will be within the city.
Okay.
We are looking at a central Mumbai type of development, very similar to our Marathon Future X type of location. We are also having like Millennium project, which is on the Mulund, on the next to touching to the metro station. So that type of inventory where within the city a good office space, small business space are also in demand. And thirdly, in the outskirts, we are looking at next zone. We are doing close to 1 lakh square feet of retail space of the completed. The phase 1 and phase 2 is already completed. Phase 3, we are looking at a large retail component in the 5 lakh square feet development. So we, office, retail kind of a combination which we would like to create for the next cycle.
And, Mr. Shah, you also mentioned about how within your residential portfolio, your affordable portfolio also has a very high ROI. Your return on investment is quite high. The sales velocity is quite high. But what we've seen in the last 2 to 3 years has been that the luxury side of the portfolio for amongst the other listed real estate players also has been quite strong. The collections have been quite strong, has been quite robust as well. So when you talk about affordable over the next couple of years going through, is your strategy that you want to address areas where there is a higher potential of first-time buyers coming into areas where it's still untapped, because that's been something that the market hasn't yet rewarded yet in that sense, if you know what I mean, in terms of stock price performance, because the luxury one much more stable in that sense. So could you give us some perspective for this rationale?
So luxury will continue. See, for our Monte South ongoing project, where we have already done Tower A and Tower B. Now we are already constructing in a very high speed the Tower C, which is 400 units. And we have a portfolio of a Tower D, another 1600 crore kind of inventory. So as and when we have scope available, we are again going to jump into a luxury residential. Even Tower C upper floor between 35 to 64 floors are yet to be launched during this year. So you will see luxury on a similar pace coming into our portfolio of the realization.
Okay, got that view, Mr. Shah. So you also had raised the 900 crore QIP in the last year. Roughly 340 crores was for debt reduction, which is now hampered. And so many congratulations for that, because you wanted to pay that off very quickly. Talk to us about the rest of the amount. What was that was, of course, for newer investments into new properties. Has that already been done? So is that 900 crores already utilized?
Yeah, for the debt part, as you rightly pointed out, it is already been utilized. The balance we are infusing as per our QIP statement into our ongoing projects. But we have set aside 300 crore for the new acquisition, which result we have been negotiating with various projects of redevelopment, JD, and all those things in particularly South and Central Mumbai, and a high value kind of a realization should be more than 40,000 square feet on carpet. We are looking at only those market, and there you will see during this year we'll be announcing at least 3 to 4 very big projects to add into our GDV.
So is there any target? Because the follow-up question, of course, would be on your return on capital employed, right? Because your ROEs are quite strong. Because you're holding so much cash in your portfolio right now in your company, you are seeing the 13 to 14% range largely maintained until last year. So could we expect that deployment of 300 crores to happen in FY27, and hence any target ROC that you are maintaining over the next couple of years?
Yeah, see, thing is, the deployment of the funds are depending on the projects acquired, and then it goes through the cycle of approval and all. So we are very confident that within the next 1.5 years, we should be able to deploy the entire fund which we have now, as per the projects which are under negotiation. And definitely, you'll see those announcements. We are looking at least 4,000 crore of GDP to be newly added during this span of 12 to 18 months by way of these new acquisition projects.
So 4,000 crores gross development value over the next 12 to 18 months, got that view. How much of that would be coming in from your Panvel landscape as well? Because you've seen a new airport come in Mumbai, that's also coming in Navi Mumbai. And hence all those around areas, as well as CM Devendra Fadnavis talking about the Naina city coming in. So as a third Mumbai in that sense, you have almost 200 acres of land there. Could you give us some perspective of the development of the same, as well as a rough timeline of what could be the expectation and how much of this 4,000 crores will include land parcels from there as well?
So, for the Panvel phase 3 of the next zone, roughly 600 crore has already been launched, and that is under progress. The Nirvana collection, which we already going through. For the Mumbai 3.0, there are very big plans of infrastructure development, particularly in our land bank, Panvel to Karjat rail connectivity, which is going on in a very high pace, and we expect that by 27 or latest by 28, we will have a local train going through Panvel to Karjat, and those stops of Chikle, Mope, all those where these are the land bank which we are having, will be really accessible for something similar happened between Kalyan and Ambernath, something like that. The development will take a very high pace. As on today, we are looking at some of the land bank coming into the development in 18 to 24 months by way of villa and plotted development. That is what we'll be focusing initially. But however, once this infra has been fully developed, like we have Sealing already operational, airport Namia is already coming up full way. Some connectivity between the two airport, high-speed rail is also coming up, and all these infra which is been planned in a big way. I think will really bring these lands into a development in a fast manner.
Got it. So a lot of those, public infrastructure connectivity projects is something that you will take advantage of. Got that point. Mr. Shah, the way you're talking, it just feels like you want to stay in MMR. So would that be a safe assessment that you're not looking to diversify out of this region for now, given the potential that you have also on realization and growth? Would that be a fair assessment?
Yes, very much. Because we at Marathon treat Mumbai as almost 19 to 20 different micro markets. And if you look at MMR's sale data for the last year, almost 34% of all India sales happened in Mumbai MMR region. Almost 1.6 lakh units are sold in Mumbai MMR. And if you look at even the inventory, is only 20 months inventory remaining. So with huge infrastructure push, if you recollect today morning only, government has announced a very big push of transferring almost 80,000 acre to the MMRDA region to push 3 lakh crores of infra projects, where 300 kilometers of metro, multimodal, all entire coastal ring road, and all outskirts area to be very well within 45 to 50 minutes to the central Mumbai is something which has been the vision of the government. And with this in mind, I think nowhere in the world such kind of a huge infra push is happening. So we would really like to be taking advantage of all our land bank situated whether in Panvel, Dombivali, Bhandup. All these land bank will be much better utilized within the Mumbai. And we really feel Mumbai MMR is going to be growing faster than all other cities.
Well, Mr. Shah, we'll have to leave it at that. Thanks so much for joining in. A lot more questions on cash flow amongst others probably in our next chat. But hopefully, best of luck for your Q4 results. Look forward to our next conversation. But thank you for joining us today.
Thank you very much for having me.
Well, that was Marathon Nextgen. A lot more, in the next 12 to 18 months, almost 4,000 crores of gross development value to watch out for. But viewers, that's the end of this time of KYC. Stay tuned. A lot more action on the other side right here on NDTV Profit.